Hello everyone, in this video I'm going to go through the topic of leverage and capital structure. In general, what capital structure is the financial sources that we use to pay for a firm's assets. So for example, when you go to buy a house, you'll usually put some money down on the house, and you can think of that is in fact equity. That's you, the owner, putting money into that asset. And then you're probably going to take out a mortgage loan, and that's debt. And so you can think of that as the capital structure for that asset is, let's say you put 20% down, so 20% of it is equity and 80% of it is debt. Companies finance their assets in similar ways. They will take equity investment, and that's investment that comes from the equity holders, the equity owners of the firm, and then they continue to receive equity investment by retaining earnings. So when a company generates earnings and generates cash flow, those funds are retained within the company, at least usually early on during a firm's life, and that's a form of equity financing. And then they'll also use debt financing in most cases to also pay for the assets that are generating even more, hopefully even more earnings for the firm. And so this topic is on the idea of using leverage or debt and the capital structure overall for a firm. And then in our next which is also our last topic, is valuation. And that valuation topic kind of puts together most of the topics we've gone through in class. Capital structure, weighted average cost of capital. We're going to talk about cash flows, capital budgeting. It kind of pulls everything all together in that one last valuation topic. But for the topic for this week, leverage and capital structure, I'm just going to go through the notes here. Later on, we're going to go through some capital structure theories. And just as a reminder, these are all theories. They are not the law on capital structure. We're going to work our way through those and kind of get an idea of how firms decide the level of debt and equity they're going to use to finance their assets. So let's get started with the notes. So the notes here say a firm's capital structure is the mix of debt and equity that the firm uses to pay for its assets. Because the value of the firm is maximized when the weighted average cost of capital, and in this blank should go, when the weighted average cost of capital is minimized. So when we get the lowest weighted average cost of capital, the value of the firm is at its highest. The optimal capital structure is the mix of debt and equity that minimizes the weighted average cost of capital. So the effect of financial leverage, and financial leverage is debt. So how does leverage affect net income, return on equity, and earnings per share? So I've got an example here, and I'll reference this example throughout the lecture today. So the current situation for the firm is that it has $10 million in assets, and it's completely funding those assets using equity. So $10 million in assets, $10 million in equity, no debt. The debt to equity ratio is therefore 0.00 because there is no debt. The share price for the firm is $25 per share. The shares outstanding are currently 500,000, and the interest rate, if the firm were to have debt, would be 8% on that debt. However, they're not paying any interest because there's no debt to pay interest on. The firm is proposing to take out $5 million in debt and using that to repurchase $5 million worth of stock. Okay, so they want to change their capital structure from all equity to 50% debt, 50% equity. In this case, the debt ratio, which is total assets divided by debt, would be 10 million, or excuse me, reverse that. The debt ratio is total debt divided by assets. So it's going to be 5 million divided by 10 million, or 0.50. The debt to equity ratio, debt is 5 million, equity is 5 million, so the debt to equity ratio here would be 1. So what would our shares outstanding be? So to get our shares outstanding, we're going to take that $5 million and we're going to divide that by $25 a share. And I'm going to use Excel for this. So I'm going to take $5 million divided by $25 million per share. And that is 200,000 shares. So that's the number of shares we're going to repurchase with that $5 million worth of debt. So that is the shares repurchased. So the shares outstanding are going to be 300,000. Oops, sorry about that. There we go, 300,000, because we repurchased 200,000 shares. And the remaining number of shares then would be 500,000 minus the 200,000 that we repurchased to give us 300,000 shares. So in our first scenario here, the firm has no taxes and doesn't have any debt. So our net income is equal to our Ebit, and we have three states of the world here. So if the firm has a recession in the next year, if the firm has a normal economy, the economy is normal, or if the economy is in an expansion, these are the earnings before interest and taxes outcomes that we expect. So our net income in the first case is going to be 500,000, 1 million, and then 1.5 million. Return on equity is net income divided by our amount of equity. Where the firm has no debt in this current column here, they have $10 million in equity. So the return on equity here would be 0.05, or 500,000 divided by 10 million. One 0.10, or 1 million divided by 10 million, or 10%. Or in an expansion, they're gonna have a 15% ROE. And again, I got that by taking the net income divided by the amount of equity that the firm has. And then our earnings per share is net income divided by the number of shares outstanding. So in this case, we have net income of 500,000 divided by 500,000 shares outstanding. So our earnings per share is just $1 per share. In the second case, we have $1 million of net income divided by 500,000 shares. So it is $2 per share. And then finally, in the last case, our net income is 1.5 million divided by $500,000 per share, or $3 per share. So again, remember in this case there is no taxes in this scenario, and so our EBIT, earnings before interest and taxes, is our net income, because there's also no interest because there's no debt. So no taxes, no debt in this first scenario, and that's how we get the answers that we got here. Okay, in our second situation, we have 50% debt, and that's our case in the proposed column. So our interest expense is going to be 8% of $5 million, and that is $40,000. I'll just show you here. 0.08 multiplied by $5 million. I'm sorry, gives us $400,000 in debt, not $40,000 in debt. So in our first situation here, we have interest expense of $400,000, and our $400,000 is the same for each level, because we have the same level of debt in each case and the same interest rate. So our net income in the first case is $100,000. In the second case, it's $600,000. And in the last case, it's $1.1 million. And again, all I'm doing here is taking the EBIT minus the interest to get the net income. So in the first case, our return on equity is going to be our net income. Now remember, we changed the amount of equity that we had from 10 million to 5 million. So it's going to be 100,000 divided by 5 million. Or 2%. In the second case, it's going to be 600,000 divided by 5 million. Or 12%. And in the last case, it's 1.1 million divided by 500,000. Or excuse me, 5 million. Or 22%. So what I want you to see from this, for the ROE, is that the use of leverage increases the volatility of the ROE of the firm based on the outcome in terms of Ebit, volatility in Ebit. Because in each case, we have the same Ebit, but we have very different outcomes, very different ranges of outcomes for ROE. In this case, it's 5%, ranges up to 15%. This starts at 2% down below and goes up to 22%. So we have a wider range of outcomes and more volatility because the firm has taken on debt in this case. And so finally, the EPS, we have $100,000 divided by 300,000 shares. So that's 33 cents per share. And again, 100,000 divided by our new shares outstanding, 300,000. In this case, it's 600,000 divided by 300,000 shares. Gives us $2 per share. And then finally, we have 1.1 million divided by 300,000 shares. Which gives us $3.67 per share. So again, the same thing in the same situation occurs here, where we have more volatility and a wider range of outcomes when we take on debt. So if the firm expects, or if an analyst expects, that the firm will have be out here in the expansion in the next year, and the economy is going to expand, they might suggest that the firm go ahead and take on some debt there, because they're going to have better outcomes for their investors. In terms of EPS, if it's just expected economy and the firm has the same $1 million EBIT as expected, then in terms of EPS, the investor is indifferent. If the economy goes into a recession and the EBIT is less than expected, is at this 500,000, then certainly the investor would want the firm not to take on any debt if these are the different possibilities for the firm. So the addition of debt to a capital structure increases the volatility So the additional debt to a capital structure increases the volatility of ROE and EPS of a firm. Why does this occur? This occurs because the changes in earnings, and that's net income, become more concentrated on less equity, because our amount of equity outstanding relative to our assets decreased as we take on debt. And in this case, it's specifically because we're taking on that debt and we're reducing our equity. But even if a firm just takes on more debt and uses that to buy assets, this is again true. So become more concentrated on less equity and fewer shares outstanding compared, and fewer shares outstanding. So how does this affect stockholders? So we've got two situations here with the resulting Ebit. So this is just a kind of a graph of our outcomes here in terms of earnings per share. So if the firm doesn't take on any debt, so that's the solid line with the blue dots, the firm gets $1 earnings per share if the investor receives an earnings per share of $1 per share if the firm has an EBIT of $500,000, $1 million, or $2 per share at $1 million, and then $3 a share at $1.5 million in EBIT. You can see here with debt, the line tilts upwards, and that reflects the higher volatility. So the 33 cents per share down here at 500,000, the same amount of EPS at 1 million, and then $3.67 at $1.5 million in EBIT. So when should the firm take on more debt? Well, and this is important in our current situation. We don't know what's going to happen in the future. So the company I'm having you look for your assignment is Lazy Boy. And you'll see that things look kind of rosy for them before coronavirus hit. We don't know what's going to happen with them now. And that's true for a lot of companies. Things were looking really good for a lot of companies in February of this year. Not so hot now for a lot of companies. So we don't know the future, at least not with certainty, and things can happen. So if we expect the firm to be, normal or good in the future, in this example, then we might consider taking on some debt because we can get better outcomes for our investors when we do that. However, if things go downhill, so think about like right now, firms may not be able to sell as much. Their revenues may go down. Their net income may go down, and their EBIT may go down, and their ability to pay that debt would also decline. And in this case, you see that the earnings per share fall and the ROE falls. In this case, EBIT, earnings per share specifically fall as a result of taking on that debt when the economy is not doing so well. So we can use this information and what we've seen above to get an idea of how much the EBIT the firm needs to have in order to support a certain level of debt. And we refer to this as the break-even EBIT. And so in our example up here, our break-even EBIT would be $1 million because at that point it makes sense for the firm to take on this $5 million in debt. The way we calculate break-even EBIT, and this is the original equation, I reworked it here because I wanted to separate out what the break-even EBIT is. So the break-even EBIT says that the shares outstanding with no debt multiplied by the interest expense divided by the shares outstanding with no debt minus the shares outstanding with debt, or this is the number of shares that in this case would be repurchased because we're using that debt to repurchase shares. That would give us the amount of EBIT we need to have in order to justify taking on this level of debt, the $5 million in debt. So I'll just work this out for you. So our shares outstanding with no debt were 500,000 shares. Our interest expense is 400,000, and I'll just show you where I'm getting that. It's 8% of 5 million, of the 5 million in debt. Let me change one thing here to make it look better. Our shares outstanding with no debt were 500,000. Our shares outstanding with debt, so we took on the debt, we used that debt to repurchase shares, is 300,000. I'm going to go over to Excel to calculate this because this 500,000 multiplied by 400,000 is a really big number. So I'm going to take 500,000 multiplied by 400,000, and it's 2 with a whole bunch of zeros afterwards. That's not going to let me. Here we go. There we go. 200 and with 9 zeros after that. And then our denominator is 500,000 minus 300,000, and that should be 200,000. Yep. And so we're going to take the big number divided by the smaller number, and it gives us 1 million. Okay. And that is our break-even EBIT then. Which was our answer up here that we saw. Okay. You'll use this in your assignment too to determine the, I'm going to give you a total of 4 levels of debt, but one of those levels is no debt, and you'll figure up the break-even EBIT for each level of debt. So I want you to know this is the break-even EBIT for $500 million in debt. If we were looking at different levels of debt, we'd have different outcomes. So now we're going to get into some capital structure theories, and a lot of times the question I get when I go over these in different classes is, are these theories true? And the thing to remember here is that these theories have a lot of assumptions. So when Modigliani and Miller, that's M&M, went through and came up with these capital structure theories, this was in the 1950s and 1960s, and they were trying to determine how companies make decisions about capital structure and also how they should be making decisions about capital structure. At that time, the idea of finance wasn't a very well-matured idea, and the concepts behind it were not that far along. And so they were starting with these ideas, and they were economists, and they're trying to come up with how things should work. And so keep that in mind as we go through these, because we're going to add complexity as we go through different theories. So this was kind of the first big theory, and the two gentlemen here are Modigliani and Miller, often referred to as M&M. They had a lot of capital structure theories. They had a lot of theories about dividends. I talked about those in the last topic area when we talked about their different ideas about dividends. So with their first proposition, it's called the pie model, and there's nothing special about that. They're literally talking about a pie. Assumptions are that individual investors can create their own leverage by purchasing equity using credit, so capital structure doesn't matter. The value of the firm is determined by the value of the firm's assets. So the value of the firm is determined by the value of the firm's assets. So they saw the firm like a pie, and pick your favorite pie: pumpkin, apple, whatever. I'm a fan of strawberry rhubarb pie. It's just a pie. Okay. And it doesn't matter how that pie is financed, according to this theory, because I, as the individual investor, can determine how leveraged I want that investment to be by simply choosing how I'm going to pay for my investment in the company. So the firm can be all assets, it should be all assets financed completely with equity. And then if I, as the investor, think the firm should have some debt, I can take out debt and use that debt to pay for my equity investment in the firm. So let's say I go to the bank. I think that the firm should have 50% debt, 50% equity. I'm going to buy $1,000 worth of their stock. I can go to the bank. I could take out a loan for $500,000 or $500 because I'm buying $1,000 worth of $500, and then I'm going to put in $500 of my own money. And so for me, as the investor, then the firm, my investment at least, has a capital structure of 50% debt and 50% equity. And this is the idea behind the the pie model for M&M. And obviously there's a lot of assumptions with this. And now we're going to get into some of their more developed ideas. The second proposition is that capital structure is irrelevant. So the assumptions here are that there are no brokerage costs, so you're not paying any cost to a stockbroker. There are no taxes. There are no bankruptcy costs. And what are bankruptcy costs? Bankruptcy costs include both direct and indirect bankruptcy costs. And I'll talk more about this later, but the direct bankruptcy costs are the costs of actually going bankrupt. And this is, hiring lawyers, paying court fees, paying the accountants, paying all the people that are involved in the process of going bankrupt. The indirect bankruptcy costs are things like loss of business because you're going through bankruptcy or the threat of bankruptcy. So if a company looks really risky, then people will avoid getting involved with it even if they aren't bankrupt yet. Like I said, I'm going to go through these in more detail later, but that's the idea here, is there's no cost of the firm to go bankrupt. Individuals borrow at the same rate as corporations. There are no information asymmetries. So what that means is that everyone has the same information. No one has more or less information than anyone else. And the final one is Ebit is not affected by debt. I want to talk about this one for a minute. So this last one isn't far-fetched, is not far-fetched. So is Ebit affected by debt? So Ebit is the earnings before interest and taxes. So it is what the result of the firm selling product, paying for that product, through the cost of goods sold, and then paying any operational costs associated with it and overhead costs, but it doesn't take into account the amount of financial leverage of the firm or the tax situation of the firm. So it is the operating income of the firm. So what primarily is going to affect Ebit is a change in demand or a change in the cost of goods that the firm sells. And so I want you to think of it this way. When you go to McDonald's or Arby's or Taco Bell, do you ask to see a copy of their financial statements? I hope not. I might, but I hope you don't do that. It probably doesn't have any impact on what you're being sold. If you hear a company is not doing well or might be facing some financial difficulties in the future, if you would choose not to do business with that company, not to either sell products to them or to buy products from them, as a result, then that would impact their Ebit. So for example, again, go to McDonald's. Again, don't go up and ask for their financial statements. You're just going to get people at the counter that are going to give you weird looks. But if you go to buy a car, you should be concerned. This happened back in 2008 with General Motors. General Motors was facing bankruptcy. They were driving head on into it. Eventually what happened is that the U.S. government had to step in and bail them out because they were not able to cover their debts anymore. And so for a short time, the U.S. government owned the majority of General Motors stock in effect to keep them alive because they were considered to be too big to fail. And one of the things they did whenever they purchased that equity is provided reassurance to people that were shopping for cars that the warranties on those cars would be good, because that is a big concern. If you're purchasing something that's under warranty, it's going to be under warranty, or that the firm is expected to provide service to those customers over a longer period of time other than just the time at purchase, then the financial situation of that firm is important. So like I said with General Motors, people were concerned that the warranty that went along with a new car wouldn't be honored if General Motors went bankrupt, because those warranties are liabilities of General Motors. And so if they go through bankruptcy, all those warranties may be voided. And so people didn't want to buy General Motors vehicles. So the bankruptcy cost there, the indirect bankruptcy cost, was very high. And one of the reasons why the U.S. government needed to step in that case in order to keep General Motors alive. Again, in most cases, customers aren't going to consider the financial situation of a firm when they go to do business with them. But there are some cases, like I said, with car companies, maybe with construction companies. Certainly, you're in the midway through a construction project, or you just purchased a building from them that there's usually a warranty that goes along with that. You don't want them to go bankrupt and just walk away. So is Ebit affected by debt? In general, it's not, but in some circumstances. The firm can also lose suppliers, or at least good terms on their trade credit. Sears has faced this, where their suppliers were looking at the financial statements of Sears and very much were worried that they wouldn't pay them if Sears bought things on credit, and something happened where they're in complete financial ruin, which they're getting closer every day. And so a lot of suppliers, and this hurt Sears and this hurt Kmart, a lot of suppliers said that they would no longer sell to Sears and Kmart on credit. So this increased their financing cost and decreased the ability of them to bring in products. So the other ones here, no brokerage cost. That's really not a valid assumption. There's usually going to be brokerage cost. No taxes, that's certainly not valid. Even if you're not paying income taxes, you're paying property taxes, you're paying sales taxes. There's other taxes that go along with that. No bankruptcy costs. Again, that's not a good assumption. We're going to address that later. Individuals borrow at the same rate as corporations. That's not a huge assumption here. Is it true? Generally, individuals have to pay a little bit more than corporations, but not a big deal here. No information asymmetries. We know that's not true. Different people have different information. So, based on M&M's second proposition, the cost of equity is determined by the required rate of return on the firm's assets, which is RA, R sub A. The firm's cost of debt is R sub D, and the firm's debt to equity ratio. According to M&M 2, the required rate of return on a firm's equity is equal to the required rate of return on the firm's assets plus the difference between the rate of return on a firm's assets and the rate of return on debt multiplied by the debt to equity ratio. Note here I say we won't use this for any calculations. This is just an explanation of what we see up here. So, as the firm takes on debt, so a firm with no debt, this debt to equity ratio is 0, and the required rate of return on the firm's equity is the required rate of return on the firm's assets. As the firm takes on debt, the required rate of return on equity increases to account for the difference in the required rate of return on assets and the required rate of return on debt and the increase in the riskiness of the firm. So RA is determined, the required rate of return on assets is determined by the business risk of the firm. So what is business risk? It arises from uncertainty in the projections of the firm's cash flows, Business risk depends on demand variability. So how much does demand increase and decrease? Sales price variability. How much does the sales price of what they sell change? Input cost variability. So the cost of their inputs, do they change much? The ability to adjust output prices for changes in input costs. And this is a really big one because for some industries, the input costs can go up and down, but they may not be able to control how much they can change the prices they sell their products for. And I'm going to give you an example of that here in a minute. The ability to develop new products in a timely, cost-effective manner. Foreign risk exposure. So this would be, based on how much does the firm sell their product overseas, or how much do they conduct business overseas, and the exposure that comes with dealing with different currencies and different markets. And then operating leverage. And operating leverage is the degree to which the firm's expenses are fixed. In other words, if a firm has a lot of fixed expenses, the firm has more business risk because in order to maintain their operations, they have to make sure to be able to make those payments. So let me start with, and just to finish up here, business risk is determined by management decisions and industry characteristics. So I think demand variability, sales price variability, input cost variability are pretty tangible ideas here. How much do those things move around? So the ability to adjust output prices for changes in input costs is a really big deal. The example I usually like to give here is agriculture. I come from a family of farmers. Farmers, if they're selling a commodity, so for my family, a lot of what they sell is soybeans. They don't get to determine. The farmers don't get to determine the price of soybeans. That is determined by the market for the demand for soybeans relative to the aggregate supply of soybeans. So, for example, if the demand is low, but it's been a great year for farmers in terms of having perfect weather, being able to get their crops out, being able to get their crops in, then the value, the price of those soybeans is going to be pretty low because there's not a lot of demand, but there's a big supply. The opposite can also happen, where demand is really high, but let's say there was a drought and there was some flooding maybe too, throw them both in there, and so there's not many good soybeans being produced that year. And so low supply, high demand is going to increase the price of those soybeans. I lived in Wisconsin for several years. The dairy association there is really big. There's a lot of dairy cooperatives, and those dairy cooperatives try to, it may sound a little harsh, but try to manipulate the supply of milk. Okay? And I've been hearing about it in the news lately, where they're asking farmers that belong to cooperatives to dump some of their milk. And the idea there is that they're going to limit the supply going into the marketplace in order to maintain prices. So if all the dairy farmers are, producing tremendous amounts of milk and they're selling it in the market, they're going to be able to sell it for less because the supply of the milk is going to outpace the demand for milk, and so the prices will fall as a result. And they don't want that. They're trying to hit the right price point to maximize the revenues for the farmers and the profits for the farmers. So we also hear, if you pay attention to OPEC and oil, worldwide oil supply and consumption, right now the OPEC nations and Russia are kind of in a little bit of a fight on the amount of oil being supplied and put out there, because they want to increase the price of oil per gallon, because it's been pushed down, of course, because of coronavirus and stay-at-home or safer-at-home orders. People are out traveling less. There's less people out on the road transporting goods. And so the demand for oil has fallen. So they want to reduce the supply of oil to maintain prices, or actually in this case increase the price of oil. So some agricultural products, the farmers, the people that are producing the goods, don't have the ability to adjust the output prices, what they're selling it for a change in input cost. The prices are determined by the market, and their individual input costs really don't affect that. Operating leverage, the other one I wanted to talk about, the degree to which a firm's expenses are fixed. If a firm has a lot of fixed expenses, they pay a lot of salaries, they might have a lot of capital leases or operating leases on equipment or property, that increases the riskiness of the firm, because if they can't make those payments, they can't continue to function. So the degree to which a firm's operations are dependent upon fixed expense items, the greater the risk the firm has. So this second argument in the equation up here, which I've got down here, is determined by a firm's capital structure. As a firm increases its debt, the business risk becomes more concentrated on the stockholders. The example we worked at the beginning of this lesson kind of shows this. Again, as the firm took on debt, in this case we just went from zero debt to $5 million worth of debt, the changes in earnings were concentrated. So earnings were $500,000 less than expected. The EPS to the investor dropped, or to the equity holder dropped by $1.67 per share rather than just $1 up here. And then in the second case with debt, as the firm made more money, the higher return was again more focused on the equity holders, because instead of getting an EPS that increased by $1, they get an EPS that increased by $1.67. If the assumptions of M&M2 are true, then the firm value is not affected by capital structure. Capital structure is irrelevant. So the next theory we're going to talk about is corporate taxes and capital structure. And in this case, what we're doing is we're eliminating one of the assumptions of Modigliani and Miller, and that is that there are no taxes. Taxes have a huge impact on a firm's desire to take out debt. If the firm has a higher tax rate, it's going to increase the attractiveness of debt. So, for example, some of you may have mortgage loans. Some of you may have school loans too, and both of those are affected by your both home loans and school student loans are have an effect, or can have an effect, on your taxes. So, for example, I have a lot of student loans. I was in college for 10 years, and as a result, every year I get to deduct the amount of interest I pay on my student loans up to $2,500 from my taxable income. So it reduces my income taxes every year because I have that debt. If you have a mortgage loan on your house, and it can be a first mortgage, it can be a home equity loan, it can be a second mortgage, but the interest from those are also tax deductible if you itemize your taxes. So what effectively happens here is, with your home loans, if you itemize, then you can reduce the amount of taxes that you pay because those are tax deductible. Interest on debts for firms in the United States is also tax deductible. And so what happens is that taking on debt for a firm can increase the value of the firm in a couple of different ways. The first way is that it can decrease the weighted average cost of capital for a firm. We'll talk more about that later. But it also can reduce the amount of taxes that the firm pays, which leaves more cash, more income available to pay out to the investors of the firm. And so Modigliani and Miller, in this case, they're coming back and they're saying we're getting rid of that assumption of no tax, and they say that a firm creates an interest tax shield by taking out debt because they get to deduct that interest expense for tax purposes. So they said that the present value of the interest tax shield for a firm is equal to the firm's corporate tax rate multiplied by the dollar amount of the firm's debt. And so the present value of the interest tax shield, and so think of this as the interest tax shield is the amount in each year that the firm gets to save on taxes by taking out debt. And they said the present value of all those future benefits for the firm is equal to the corporate tax rate for the firm multiplied by the dollar amount of debt. So for example, if a firm's corporate tax rate is 40% and the amount of debt a firm has is $1 million, the present value of the interest tax shield is $400,000, 40% of $1 million. So you can see that this could have a large impact on the value of a firm by just taking out some debt. So the interest tax shield increases the cash flows available to all of the firm's investors. So I'm going to go through an example here. We're going to take that original scenario where there is no debt or 50% debt, but now we're going to include the effective taxes, and we're going to assume that the firm pays a 40% tax rate. So, and I'm just using this example that we worked at the beginning of these notes. So going with this example up here. But now instead of not having any taxes, we have a 40% tax rate on the firm's income. So if there's no debt, there's zero interest expense. In each case, our earnings before taxes are just the same as the Ebit, 500,000, 1 million, and 1.5 million. The income tax is going to be 40% of the earnings before taxes. So I'm just taking 40% of that 500,000. So my income tax is 200,000. My net income is 300,000. In the second case, my income tax is 400,000, or 40% of that 1 million. In the last case, my income tax is 600,000, or 40% of 1.5 million. My net income then, in the second situation, is going to be 600,000. The difference between that 1 million and 400,000. In the second case, it's going to be 900,000. The difference between that 1.5 million and 600,000. I apologize for the coughing. I have allergies. I forgot to take my allergy pill this morning. And so getting a little coffee today. So the return on equity for the firm is going to be the 300,000 divided by the amount of equity that the firm has. So in our first scenario up here, the firm has $10 million in equity, and then with the debt, it only has $5 million worth. So I take 300,000 divided by 10 million, and that is going to be 3%. In the second case, I'm going to take $600,000 divided by 10 million, and that's going to be 6%. In the last case, I'm going to take 900,000 and divide it by 10 million. That's going to give me 9%. The earnings per share then, we have $300,000 in net income. Our shares outstanding with no debt were 500,000 shares. So 300,000 divided by 500,000 is 60 cents per share. $0.60 per share. $600,000 divided by 500,000 shares is $1.20 per share. And then the last case, 900,000 divided by the 500,000 shares is $1.80 per share. All right, so let's take a look here. What happens if the firm takes on that debt? So we have $400,000 in interest, just like we did before. $5 million in debt, 8% interest rate. Our earnings before taxes are $100,000, $600,000, and then $1.1 million. Our income taxes here is going to be $40,000. $240,000. I'm just taking 40% of that amount. And then $440,000. So we get a net income of $60,000 in the first case. $360,000 in the second case. And then $660,000 in the last case. So we can see here the firm paid a lot less out in taxes by taking on that debt. The return on equity, so remember in this case the equity amount is $5 million instead of $10 million. So 60,000 divided by 5 million is equal to 1.2%. In the second case, we have 360,000 divided by 5 million. Or 7.2%. And in the last case, oops, that didn't go right. There we go. In the last case, 660,000 divided by 5 million. Gives us 13.2%. The earnings per share, so our number of shares outstanding is 300,000 shares because we repurchased 200,000 shares. So 60,000 divided by 300,000 is 20 cents per share. $360,000 divided by 300,000 is $1.20 per share. The last case, 660,000 divided by 300,000 gives us $2.20 per share. So just to review, in our first scenario, we have no debt. In the second scenario, we're taking out $5 million in debt. We're repurchasing 200,000 shares of stock with that money. The firm has a 40% tax rate on its income. We can see here again, if the economy goes into a recession and the Ebit for the firm decreases, the firm's better off by not taking on that debt. If in this example, if the economy goes as expected, then the investors, based on the earnings per share, would be indifferent. It doesn't matter to them whether the firm has debt or not. In the last case, in an expansion, the stockholders are better off if the firm does take out the $5 million in debt. And we still see that it's more volatile for the stockholders if the firm takes on debt than if they don't take on debt. So for the expected outcome, so we're looking at this column right here. The cash flow to the stockholders if there's no debt is going to be equal to the net income, because we're saying that the firm pays out all of its income as dividends to the stockholders, which isn't always the case, but it's at least available to the stockholders. So the cash flow to the stockholders with no debt is $600,000. To bondholders, it's zero because the firm has no debt. So the total is $600,000. With 50% debt, the stockholders get $360,000. The bondholders get $400,000 because that's the $400,000 in interest that they get. So the total is $760,000. The interest tax shield for the year, because the firm took on debt, is equal to $760,000 minus $600,000, which is equal to $160,000. So because the firm took on debt, in the expected outcome, they're able to generate $160,000 more in cash to pay out to investors. Okay, and this, the payout obviously here is going to the bondholders for the firm. But in the expected outcome, the stockholders, because they're getting all of the firm pays out all of its net income, the stockholders are still getting $1.20 per share. So they don't care in that case, they're getting the same cash. If the firm does better than expected, the bondholders, the amount they get doesn't change. So the greater reward is concentrated on the stockholders, where they're getting $2.20 per share, where they're with the debt, where they would only get $1.80 per share without the debt. So according to Modigliani and Miller, if we assume that there are no bankruptcy costs, but we do assume that the firm pays taxes, then the value of the levered firm, this is the value of the firm with debt, is equal to the value of the firm with no debt, also referred to as the value of the unlevered firm, plus the corporate tax rate multiplied by the dollar amount of debt. So based on this equation, if the corporate tax rate is greater than zero, then the firm's assets should be paid for completely with debt. And that's because for every dollar of debt you add on the corporate tax rate multiplied by that dollar in value. So the value of the firm is maximized when the firm is totally financed with debt, or the firm's assets are totally financed with debt. And you hear that and you might say, well, that's ludicrous, because then we would see firms that have, $1 in equity and everything else is debt. So why don't we see that? Well, the reason we don't see that is because of the next theory we're going to talk about, which does include the bankruptcy cost. So this is referred to as the trade-off theory, and the trade-off is the benefit of debt in terms of this tax shield, and the cost of debt in terms of the bankruptcy cost for the firm. So according to this theory, firms borrow up to the point where the tax benefit from an extra dollar of debt is exactly equal to the cost that comes from an increased probability of financial distress. Put another way, the optimal capital structure is the mix of debt and equity that makes the marginal tax benefit of debt equal to the marginal bankruptcy cost. The trade-off theory implies that firms can have optimal capital structures. So let me take a minute and explain in more detail what that means. What the idea of a firm having an optimal capital structure means is that for any firm, if that's true, if a firm can have an optimal capital structure, we should be able to take the characteristics of the firm and determine which mix of debt and equity will provide the greatest value, will maximize the value of that firm. Okay. So the trade-off theory is somewhat unique in saying that there is one capital structure, and not for every firm. It's not the same capital structure for every firm, but for each firm, there is a capital structure that will maximize the value of that company. Okay. So And so this theory here takes into account the bankruptcy costs for the firm. There's not an equation for this because the bankruptcy costs can't be directly determined, but there are some evidence that we can look at, and I'm going to talk about later, where we can get an idea of where that point lies for the firm. So bankruptcy costs, I talked a little bit about this earlier, but I'm going to go into more detail now. So a bankruptcy costs for the firm are the costs associated with financial distress and the firm ultimately going into bankruptcy. There are two primary forms of bankruptcy here in the United States. Chapter 7 bankruptcy is liquidation. So under liquidation, the bankruptcy court orders that the firm's assets be sold and the proceeds are paid out to the firm's creditors, employees, and then all the costs associated with bankruptcy. And these people go first: lawyers, accountants, government. If the firm owes any taxes, those usually are some of the first things that get paid. Anything that is left over then goes to the firm's equity holders or their stockholders. The stockholders are residual claimants, meaning they get paid last. Typically, when a firm goes into Chapter 7 bankruptcy, there's no money left for the stockholders. In fact, not all of the creditors, not all the bondholders are going to get paid either. They usually get a portion of what they're owed. Chapter 11 bankruptcy is reorganization, and I worked for a firm that went through this. When I was in college, I worked for a firm by the name of Eagle Pitcher, and it's EAGLE-PICHER. It's down in Joplin, Missouri. They, for many years, sold asbestos and things containing asbestos, and when people started getting very sick from this, getting something called mesothelioma, I think that's how it's spelled. Yeah, that sounds right. Eagle Pitcher got sued, along with other companies that sold this product. As a result, the amounts that the company owed out were extremely high, and the company would have gone into liquidation had the bankruptcy court decided that the company as it was had enough prospects and had enough an ability to generate additional income and continue to operate as long as the debts that were owed by the company could be reorganized so they would have the chance to pay them off, or a chance to pay a reduced amount and still function. In the case of society, society often benefits or should benefit from reorganization because it keeps a company around that and keeps people employed that it otherwise wouldn't. So if we go back to General Motors, the case of General Motors back in 2008, the situation there was that in its operations, General Motors was going down a situation where they would have gone out of existence had the government not stepped in. So they went through a form of reorganization, although it was very different in their case because it was the operations of the firm itself that were burning through cash. So in the case where I worked, the operations were profitable. The things we did were profitable. It was this lawsuit and the high amount of the payout from this lawsuit that Eagle Pitcher needed to pay out to the claimants in the lawsuit that caused it to go into bankruptcy. The company no longer sold asbestos and hadn't for years and years and years. They did use, my wife worked in, so what I did there is I was on the business side. I sold batteries. I sold special purpose batteries. Generally, 90% of the time, the batteries I sold were for military purposes, so they went in things like grenades and missiles and ejection seats. Those were pretty expensive ones for military purposes. They were very expensive batteries because you don't want a grenade going off when you're not expecting it to go off. And when you want that grenade to explode, you really want it to explode. So our batteries that we sold had to be guaranteed not to fail for 7 years. So, there was a 0% accepted failure rate for the batteries that we made because, someone's up flying a fighter jet and their battery malfunctions in their the ejection seat, battery malfunctions, and they get ejected out because it goes off when it shouldn't, or when they need that ejection seat to work, it has to work. So we had the costs were very high because we had batteries that were very special purpose. My wife worked in a different area of the company. She made batteries too. She made a different type of battery. Her batteries went up in satellites, and so they're often used for things like cell phone communications. Again, those batteries always had to work. They weren't going to send up people to go fix the batteries after they had been launched up, and it cost millions and millions and millions of dollars to launch a satellite. So the batteries in those satellites had to work for an extremely long time, and again, no acceptable failure rate. So that's what we did, and the government decided that our business couldn't go out of business because in the area that I worked in, we were a sole source supplier. In other words, we had a monopoly on what we did because the government didn't want to share the information with anyone else about what we did. So the government had a reason to keep us around, and we were able to show that the existing operations of the firm were sound, and that we could, if our debts were reorganized, we could eventually pay those down and give people the money that they needed or that they deserved and that was owed. But we had to extend the time schedule over which those were paid. And so a bankruptcy judge in the bankruptcy court will often let companies survive but be reorganized if they can demonstrate their ability to continue to generate income, positive income, and pay off maybe not the original debt amounts, but a reorganized amount that everyone is in agreement on. So we divide up bankruptcy cost between direct bankruptcy cost Bankruptcy is a legal process. Direct bankruptcy costs are the costs that are directly associated with bankruptcy. This includes court costs, attorneys, lawyers. In the case of liquidation, selling the firm's assets, the discounted prices the discounted prices received from selling a firm's assets in liquidation. If you've ever been to a liquidation sale of a big company, oftentimes the products are being sold for less than their original amounts and probably less than the value on the balance sheet. So that discount is a cost, is a bankruptcy cost, because they're not going to get as much out of it as they expect, or the amount on the balance sheet. They're not going to get that amount out of it. So those are direct costs of going through bankruptcy. Indirect bankruptcy costs, these are the costs associated with the firm being in financial distress and attempting to avoid bankruptcy. If a firm is known to be in financial distress, how may the following stakeholders change how they engage in business with the firm? I mentioned this before with the idea that some firms are not affected, their Ebit is not affected by the threat of financial distress. Like I said, you go to a restaurant, you're not asking for their financial statements. So oftentimes customers aren't concerned. However, businesses that engage in long-term relationships through their business, through their operations, should expect to see customers leave with the threat of bankruptcy. And operations may not be the best word there, but I didn't want to use business again. So, examples of this: car companies. I mentioned that before because they have warranties on firms. Construction companies. Many people have been left holding the bag of a partially completed building when a construction company has gone bankrupt. Let's see, really anything with a long-term warranty. I mentioned the company I worked for. We had long-term relationships with our customers because those batteries had to last for many years. They relied on us for long-term projects. We'd have projects where we were creating custom batteries with the government over many, many years, and also the government's contractors. So, for example, we would do a lot of things with Lockheed Martin. That was a big one we worked with. L'Oreal was a big one we worked with. But big manufacturers, Boeing, of military goods. These are some companies that might be impacted by indirect bankruptcy costs. Suppliers, again, I mentioned firms like Sears and Kmart, where their suppliers saw what was happening with them, saw their lack of cash flow. This also, by the way, happened with General Motors. Their suppliers got very worried because General Motors was a large part of their business. Delco being an example there, DELCO. And were really hurt, or had the potential of being really hurt, if General Motors went out of business because they would no longer get paid. So suppliers will often reduce the amount that the firm can purchase on credit. So I mentioned that a company I worked for went bankrupt. They went through reorganization, and I was an intern at the company at the time, a college intern, and I was sent down to I eventually went to work there full time, but I was sent to the office supply store to buy some office supplies, and we had a credit account there, and I went and I got what we needed, and I said, put it on our credit account, and the employee looked at me and said, no, you guys went bankrupt, and we didn't get paid out everything that we should have been paid, so we won't issue you credit anymore. So I had to get reimbursed for that little run there, but it happens. So suppliers will often reduce the amount the firms can purchase on credit or eliminate trade credit entirely. This is something that Eddie Lampert, the CEO of Sears, complained about when they were going through their troubles. Basically, and he did come out and say that their suppliers were trying to take advantage of them because they reduced the terms that they were willing to sell to Sears and to Kmart. Both of them are the same company because of their financial problems. So that increases the cost to the firm that's going through financial distress, because then they have to either not sell products or they have to come up with the cash, and oftentimes through borrowing money at high interest rates in order to pay for those products and not have the time to sell them before the bill is due. So that can really hurt a firm through the indirect costs of bankruptcy. Employees. Good employees will leave. If it looks like a firm is going to go under, your good employees are oftentimes going to leave the firm. They're going to go somewhere else. So you're going to have additional hiring costs because you probably need to fill some of those places, some of those positions. And so your good employees will often leave, and things get more chaotic for the firm. Lenders and bondholders. Required rates of return on debt will increase. Lenders will either increase interest rates or refuse to extend credit. The ability to take on new debt if the firm is in financial distress is pretty low. When I worked for banks, we were in situations sometimes where we would have to either choose to make a loan or the firm would go into default at that time. And in fact, we had this happen in one specific case where we had an operating loan out to a firm where they used this loan to purchase their inventory and to pay their employees, because it was a cyclical company. And they came to us and said, the bank that we have, our lender for our building, which was not the bank I worked for, is telling us because of our financial situation that they're not going to renew our loan, our mortgage loan on our building. So either you need to take on this loan or we're going to go out of business and you're not going to get paid. And we had to make the decision in that case just to also refuse to make that loan to them. And we did take a loss on the operating loan, but it would have been far greater. Our loss would have been far greater had we extended the loan out on the building for them as well. And so that certainly does happen. So the big idea here is that due to the existence of direct and indirect bankruptcy costs, as the firm takes on more debt, the required rate of return on debt increases due to the increased risk of bankruptcy. And so as the firm takes on more debt, the required rate of return on debt increases. And if we go back and we look way back here with Modigliani and Miller's second theory, we also know as the firm takes on more debt, looking at this equation here, the required rate of return on the firm's equity also increases. So as a firm takes on more debt, the cost of debt or the required rate of return on debt increases. The required rate of return on equity also increases because the risk to the equity holders increases as well. The next theory doesn't say that there is an optimal capital structure. It's referred to as the pecking order theory. And in this case, what happens is that as a firm needs cash to finance assets or to finance their operations, the firm goes through a pecking order. So according to the pecking order theory, firms don't have optimal capital structures that they target. Instead, firms choose the form of capital as financing needs arise based on preserving asymmetric information, okay, and two, reducing or minimizing financing cost. So the pecking order theory states that most firms will choose capital structures in the following order when financing needs arise. The first thing that they're going to choose is retained earnings. So the money that the firm is generating that belongs to the stockholders, they're going to use that money for their financing needs first. The second is issuing new debt. Because remember, they can't use the existing debt they have because they've already used that up. Okay, they need more cash, and so they're going to issue new debt after they've used up their retained earnings, and then finally they'll issue new equity. And we in a previous lesson we talked about this. Firms really don't like to issue new equity because it's expensive. It forces the company to share information, and it dilutes the ownership control of the existing shareholders. So why does the firm follow this order? Well, retained earnings if the firm uses earnings that it's already generating, then they don't have to release any new information about what they're using the money for. And secondly, because the firm already has the money, there are few, if any, financing costs. Now, I do want to mention that this ignores the required rate of return to stockholders, because there is a cost or a required rate of return for using retained earnings. However, there are no financing costs involved with it. They don't have to pay any fees to issue this money. They don't have to actually pay out interest expense or interest to investors from this. They may be paying out dividends, but they don't have to pay it. So under this theory, firms will use up the retained earnings that they have first before they'll try to issue any other kind of financial instruments. The second thing they're going to do is they're going to issue new debt. Issuing new debt generally requires the firm to share information about what the proceeds of the debt if the firm is borrowing from a bank, the bank's going to ask them, what's the purpose of this loan? What are you going to use the proceeds for? If they issue new bonds, they're also going to need to tell the prospective investors what the bonds are going to be used for, what the proceeds of those bonds are going to be used for, because what they're going to be used for is important to the investors and important to the risk of the firm and to that security specifically. Interest rate, the interest cost, and the financing cost, the cost of issuing that debt is fairly low compared to the cost of issuing new equity. Finally, issuing new equity is usually the last choice because we've talked before about why firms don't like to issue new equity. I'm just going to review that here. Firms avoid issuing new equity, and remember I gave you 3 reasons. 1, new equity has high flotation cost, and these are not in any particular order. Issuing new equity dilutes the control of existing stockholders. And finally, issuing new equity sends the signal that the price of the stock price, the stock is overvalued in the market, which is going to have a negative impact on the stock price. So firms really avoid issuing new equity. Plus, companies because of these reasons, the companies generally have to provide a lot of information, really reduce those information asymmetries in order to get investors to purchase that stock. And firms don't like to give up a lot of information. I've included in the on D2L a link to a story, and actually turns into a lot of different, several stories about the whole saga of when a software engineer at Apple lost an iPhone or forgot his iPhone at a bar, and what happened with that, because Apple didn't want to immediately state that it was in fact their phone, that it belonged to them, because it was a prototype of the next iPhone that they were putting out, and they didn't want to acknowledge that in fact was the next iPhone coming out, because a website called Gizmodo had gotten a hold of it and had taken pictures of it and had went through it and found out all the specifications of the phone, and Apple didn't want that information released officially that this was the new iPhone and these were the specifications of the new iPhone, because they knew that their competitors could get that information and start to plan on how to compete against them on their new phone. But companies oftentimes do not want to share information, and so they will put off issuing or just avoid issuing new equity because of that and because of the other reasons that I've given you up here. So that's the pecking order. And again, the idea here is that when a company needs more money for investing into the firm, they're going to go through this order. They're going to start with retained earnings. When they run out of retained earnings that they can pay out, they're going to issue new debt. When they run out of new debt to pay out, because they're going to get to a point within a fixed time frame, there's only so much debt a firm can take on before the interest rates get too high for them, or before the banks and the lenders and the bondholders just say no, that they're not willing to give them more money. And then finally, when they run out of that, the firm can issue new equity, and again, they'll usually stop before that happens because companies don't like to do that. So some capital structure, some managerial recommendations. So one thing that you're going to see in the, that you should see throughout all this, especially when it comes to taxes, as tax rates increase, debt provides a greater benefit to the firm because they get to deduct the interest from their income for tax purposes. So taking on debt reduces the amount of tax they have to pay out and provides more cash to investors. So as tax rates increase, debt provides a greater benefit to the firm. Financial distress. As the risk, as the probability of financial distress increases, the firm, if they can, should reduce the amount of debt that it has. The cost of financial distress depends primarily on the firm's assets. If the firm has good general purpose fixed assets, the cost of bankruptcy declines. And specifically the discount that they're going to take on the value of those assets is going to go down when they have to liquidate, if they have to liquidate. And that's because general purpose fixed assets can usually be sold for a higher amount or a higher percentage of their book value than what rare kind of less general purpose, more fixed specific purpose assets can be sold for. So for example, airlines tend to have a lot of debt, and it's a little surprising because airlines are also very sensitive to market risks. We can see right now with what's going on with the economy and the coronavirus, airlines are really hurting and they're really begging for bailouts there because people aren't flying. Whenever the economy goes south, people aren't traveling as much for vacation. Businesses don't have money to send people on trips. And so airlines are generally, hurt a lot. And that would generally, a firm being very sensitive to market risks would decrease the attractiveness of debt because it makes the firm riskier. However, airlines tend to have a lot of debt because they have these general purpose fixed assets. Those airplanes can usually be sold for fairly high amounts because the cost of rebranding an airplane isn't very high. They go out and they paint it, and they might have to do a little rebranding and some changes on the inside of the airplane, but by and large the cost of changing the carrier for an airplane itself is not very high, and so those assets retain a lot of their value. Two things about airplanes that are nice is that, one, first of all, they're hard to hide. It's very difficult to hide a 747. It's very difficult to lose one. So it's not like a car where someone can steal your car and just take off with it. When I worked for a bank, we would have people who would stop paying on their cars and then conveniently not leave them out on the street where we could pick it up or leave it somewhere where we could find it. Cars are easy to hide. Airplanes not so much. So they're hard to find. They're hard to hide, but they can be moved around. So a building can't really be moved. You might try to move a building, but in general, when a company buys a piece of land, they put a building on it. That building is going to stay where it is, and that makes it not quite as attractive as an airplane as collateral. Because if someone wants a 747, when it's sold, it can be moved to wherever they are. You can't move a building. So things like airlines or companies like airlines, companies that have general purpose fixed assets tend to have more debt because the bankruptcy costs are lower for those companies. The cost, the riskiness of the debt is less to a bondholder because the assets can be sold and the bonds paid off in those cases. A reason why houses are good assets, good collateral, in specifically houses, because we know that homeowners will generally make sure that the house payments are made first, or after any absolute necessity has to be paid, that house payment gets paid. even if it doesn't make financial sense for the person, because there is a psychological impact from losing one's home that people want to avoid. So you can have a house that's worth less than the loan, what's owed on it, but people will still fight to keep their home. And so they tend to be good collateral for lenders. If a firm doesn't have very good general purpose fixed assets, so things like software companies, things like pharmaceutical companies, they tend not to have a lot of debt. Because if a software company, think of a company that makes video games, if they go to business, what is there to take to collect the cash on? If people aren't playing the video games and they're not popular and the company's not making money, the video games, the software, really isn't worth a whole lot. And so those types of companies tend not to have a lot of debt. Apple for years had no debt. They started taking on debt a few years ago. And honestly, even though Apple is an incredibly profitable company generating a lot of cash, it's not the type of company that would generally have much debt because they don't have a lot of general purpose fixed assets. Their manufacturing, they don't do their own manufacturing. That takes place overseas, not with assets that they own. A lot of the value of Apple is tied up into the trademarks and the copyrights they have around their image and the patents of their software. So those things wouldn't have much value if Apple's not doing well, if people aren't buying their product. So I want to talk about the one special case here, and that's nonprofit organizations. And I want to talk about it because I studied this for several years. I've published a few papers on the topic of capital structure for nonprofit organizations, and they're somewhat unique because they don't have that tax benefit. (501c3s) don't pay any taxes, and they're specifically for 501c3s, their donors get to deduct their donations for tax purposes. Then you have some nonprofit organizations that are like 501c4s, where they also don't pay taxes, but on their income, but their donors don't get to deduct for their donations for tax purposes. But there's no tax benefit to debt for nonprofit organizations. And as a result, what I found in my research is that nonprofit organizations are far less likely to take on debt than for-profit organizations. Putting organizations in there, but we're talking about companies here. So I've looked at 501c3s specifically. So what that would include would be charities, charitable organizations, not including churches, because that information isn't available. But if you're interested in looking at nonprofit, charitable 501c3 organizations, and this is something that I did for this research, was you actually can access their 990 form. So this is kind of their tax return that they turn into the government, even though they don't have to pay taxes. In order to get the 501c3 and maintain that designation, they do have to turn in a 990 form every year. If they are of a certain size, it's a fairly detailed form, and so that's what I did my research off of. So what I found was that these organizations are far less likely to take on debt. Only about 50% of these, and these were larger nonprofit organizations, not very small ones, but only about 50% of them had any interest-bearing debt for the years I looked over a 10-year period. Over this 10-year period, they just didn't take on, a lot of them didn't take on debt, and if they did, there wasn't very much. And so they generally avoid taking on debt, again, because part of the reason is because the benefit just isn't there for them. There's no tax benefit. Also, They also avoid taking on debt because when they take on debt, they have to give up some of the authority that they have over the organization. So there's no tax benefit to debt for nonprofits. Nonprofits have no owners. So there's no stockholders of 501c3 organizations. And 501c3 is the part of the tax code that lays out the rules for these, there we go, of these organizations. They don't have owners. The managers of nonprofits generally, and this is not in every case, but oftentimes capture the company. So they act instead of stockholders and boards of directors. The managers of the 501c3s will often take control of the company or the organization, and there are boards of directors. And not many times, and what my research found was that many times boards of directors, the people on the boards, aren't terribly qualified for those positions. And that's not true in all cases, but in many cases that is the case. So taking on debt requires the organization to give up information. So when they go to take on the debt, they have to give up information and to lose some control over the organization. And they don't like to do that either. There was a famous study that was done that looked at 95 nonprofit organizations out in Los Angeles, and they found that the larger nonprofit organizations were more willing to work with other groups, and in order to get things done. Smaller ones, though, that were more at risk, and they attributed this behavior to this, that were more at risk of losing autonomy, losing control, were less likely to work with other groups of people or other groups of investors, if you will, to engage in activities. And really what was behind that was the loss of autonomy, the loss of control over the organizations. So over the last few years, I've specifically looked at hospitals. Most of the hospitals in the United States are not-for-profit organizations. So, for example, here in Topeka, we have 2 hospitals. We have University of Kansas Medical Health Center. Traditionally, it's St. Francis. It is now actually a for-profit hospital because they teamed up, KU teamed up with a for-profit company to purchase this hospital. And so that is actually a for-profit hospital here in Topeka. And Stormont Vale is a not-for-profit hospital. Not-for-profit hospitals do tend to take out debt, unlike 501c3s, and not-for-profit hospitals are not 501c3s. You can donate money, and you can donate and get that tax deduction for that money, but what you're generally doing is donating to the foundation of a hospital. And for example, Washburn has a foundation, and it is also a 501c3, and you can donate money, and they would really like you to. Donate money, and I would really like you to. Donate money to the Washburn Foundation, and that is that tax-deductible donation. So not-for-profit hospitals, the hospitals themselves will often take out money or take out debt. And it's interesting because the majority of it is in the form of municipal bonds. So what happens is that the hospital can go through a municipality. So here, in Topeka, that might be the city of Topeka. It could be the Shawnee County. It could be the state of Kansas, and have that municipality issue municipal bonds. Municipal bonds investors in municipal bonds and let me just stop and explain one thing. The proceeds of these bonds have to usually be used for either real estate purchases or either building or doing work on existing buildings. So they're all tied to real estate. They can't be used for operating expenses and things like that. So investors in municipal bonds don't have to pay tax. Usually don't have to pay taxes on the interest income of the bonds. So they see it as a benefit. Investors in municipal bonds generally have really high tax rates, and so they will invest in the municipal bonds because they don't have to pay taxes on that income, and so it's a benefit for the hospital, and because they can pay lower interest on those bonds because they're adjusted for the fact that they don't have to. The investors don't pay taxes on them, so the hospital benefits from issuing these types or having these bonds issued for them, and the investor benefits because they don't have to pay taxes on that interest income. It's something that I've studied quite a bit about, and it's something that might be relevant for you in the future, so I wanted to include it there. So that's the notes for this topic. I'm going to go to your assignment now. It's out on D2L. So it looks a lot like what I was doing in the notes, but there's something additional that you'll have to do here. So it's under the capital structure assignment. I'm having you look at Lazy Boy and trying to determine how much debt that the firm should take on. So here's your assignment. So I'm having you analyze whether or not Lazy Boy should take on debt. And let me preface this by saying that Lazy Boy has just recently either taken on debt or taken out some capital leases, which are often treated like debt. So I'm going back a little bit in time, just to the previous fiscal year when they had not yet taken on any debt. Although some of the information I'm going to give you is more recent than that. So I asked you to complete the Excel worksheet by filling in the yellow spaces, and I'll show you that here in a minute. I'm giving you two reports, both by a company called Valueline. Valueline is really well respected in the investment community. A lot of research has been done on their different factors, how they rate things, and they've shown that especially there's one factor called the timeliness rating, where that getting a 1, which is the best timeliness rating, is predictive of higher stock returns for a firm. And so it's a well-respected and very concise reporting format. So I'm showing you that if you live in Shawnee County, you have access to Valueline through the public library. You can even now, when they're not open, you can go out on their website and look under databases. It's like research and databases, and go to the business area, and they have Valueline on there. I know personal investors that do subscribe to Valueline, although it is very expensive. So I give you the Valueline report for Lazy Boy, and then a Valueline report on the industry of furniture and home furnishings. So the first thing I ask you to do is to read the Valueline report, and I'll show that to you here in a minute. And then to read the industry Valueline report for furniture and home furnishings, and to answer just a couple quick questions about those reports. And then you'll need to up here complete the Excel worksheet, and then answer the following questions. Do you think the Ebit of $125 million is reasonable? There's not really a right answer there or not. I'm having you use it for the worksheet, but I just want you to think about maybe from the information in those reports and the information on the spreadsheet, whether or not that is a reasonable assumption. Should the person making the decision assume that the EBIT for the next year is going to be $125 million? Review the sources of business risk from the capital structure notes. Based on the information provided in the articles, which of the sources of business risk, those were things like the variability of input costs, the variability of output prices, the ability to control prices, foreign exposure, operating risk, those things. You don't have to go through every business risk, but pick 2 or 3 business risks and indicate whether or not they would be high or low for well, actually, which ones would be relevant for La-Z-Boy. And then finally, the last question. You're given 4 potential levels of debt for La-Z-Boy, one of those being no debt. And then, after you go through the worksheet, explain which one you think is best. And there is a right answer here, based on the information in the worksheet. So let's go to the worksheet. Well, actually, I'm going to first pull up the value line reports. So this is the La-Z-Boy. Their ticker symbol is LZB. And like I said, I really like these reports because they're very concise. And they're well respected, how the company is. They'll put out several reports a year for... Oh, that's the wrong one. There we go. All right, so this is what it looks like. Some information that's important, might be important if you're looking through this. This bolded and italics numbers here, those are forecasted numbers. They're estimates for the future. So, La-Z-Boy's fiscal year end is in April, so it hasn't finished for this year yet. That's why 2019 is still an estimate on this report. The date of this report is March 20th, 2020, so it's very recent. It's only about 3 weeks old, a little over 3 weeks old. So at this time, the coronavirus was starting to have a pretty large impact. Certainly that impact has increased since then. And so there's a lot of information here, but this is what I want you to focus on, is this this discussion about the company here. And then, if you have any questions about anything on here, please let me know. Again, it's fairly well respected. Their estimates generally tend to be pretty good and pretty predictive of the future. And then I'm going to go to the industry report. This is just a report on the industry. You'll notice it's the same date that La-Z-Boy came out, so I'm assuming it's the same analyst that went through La-Z-Boy and also updated this industry report for them. And it talks about just a short report on what's going on in that industry. The last piece of your assignment is the spreadsheet itself. Sorry about that. Let's see. Here we go. And here's the workbook you'll need to complete. So what I've done, this looks different than what we did in the notes, but the calculations are the same. So I'm just going to work through this top line here to show you how it's done. For the interest expense, we're going to take the debt amount multiplied by the pre-tax cost of debt, the interest rate, and that'll give us the interest expense for the amount of debt. The shares repurchased are calculated as the amount of debt divided by the stock price. The shares remaining are equal to the amount of shares outstanding minus the shares repurchased. Then the break-even EBIT is that equation that's in the notes. That's going to be equal to the shares outstanding before any are repurchased multiplied by the interest expense. And notice I put those in parentheses, divided by the shares outstanding with no debt, divided by the shares outstanding with debt, the shares remaining there. And that'll give us our break-even EBIT. In other words, at this point, at this EBIT, we investors would be indifferent for that amount of debt. If the expected EBIT is higher than that amount, then the investors would want to take on the debt. If the expected EBIT is less than the amount, the investors would be hurt. The equity investors would be hurt by taking on that level of debt. And what you want to do is fill out the rest of these cells with the information the way that I showed you how to do that there. The EBIT for the past 5 years for Lazy Boy is given here. Fairly steady, but it went up here quite a bit between 2015 and 16, and then went down for between 2018 and 2019. I've given you the average and then the median over the last 5 years, assuming an EBIT of 125 million. So that's the amount we're assuming. One of the questions in the assignment is whether or not that is a good expectation to have when making this decision. The interest expense in this table here, if there's zero debt, there's zero interest expense. And then the other interest expenses will come from this table. So for this cell here, interest expense is 17.5 million. And then just like we did in the notes, you're going to subtract the EBIT minus the interest expense to get the earnings before taxes. You'll take out the interest income taxes. So income taxes is 26.42% of the EBT. And then you'll calculate net income, and the earnings per share for each of these is going to depend on the number of shares remaining. Okay, so with zero debt, they're not changing the number of shares outstanding, so it's going to be divided by 46.659 million shares. With $350 million in debt, the number of shares remaining are approximately 36 million. You'll use this number here to calculate earnings per share, and then so on for the rest of these. And then the cash flow to the stockholders were just like in the notes. We assumed that all earnings went to the stockholders, and so your cash flows to stockholders are going to be the net income. To bondholders is going to be the interest expense. So for this first year, the amount to the stockholders is going to be net income. To bondholders, it's going to be zero because there's no interest expense. And so for the interest tax shield is also zero because there's no benefit to debt because the firm's not taking on any debt. The interest tax shield for the remaining years is going to be the value, the total amount that you get here minus the amount with no debt. So the difference there is the interest tax shield to benefit. Let me know if you have any questions as you go through this. Please don't wait till the last minute, but do let me know, and I'm happy to take a look at your work. If you've got a question about what if something doesn't make sense to you, or you're getting something weird, I can't pre-grade your assignments because then I'm giving out the answer key. But if you do have any questions, or you're frustrated with part of it, or don't understand part of it, please let me know. Please don't wait. And let me know, and I'm happy to help you out with that. Take care. Hope you stay safe. Hope you stay well, and I will talk to you soon.